Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here this Friday morning on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Mangalam. Guys, hi, good morning. If you were hoping, at least I was when I woke up this morning, hoping for a nice, quiet Friday after a pretty tumultuous week. It's not to be. I mean, I think I can tell you that. It's not going to be a quiet day.
I completely take the blame for that because the last two times I've joined on a Friday, the news that we had were worth 2-3 Mondays, and that repeats today as well.
I think so, and that really makes the two of us. I really thought, okay, fine, big week, and now we're having a quite nice end to it. Not much happening with the market. But no, there's always something happening. And this time, I think a lot of it has to do with New Delhi.
Absolutely. And people may be wondering, because we kind of caught on to it late last night, early this morning. Yeah. What are these guys talking about? I mean, US markets are up and things are looking quite okay. It's the flashes at the bottom of the screen, which we will discuss in greater detail. That is the big one. It's a big sort of blow for the debt mutual fund industry. As I said, more in just a bit from now. But, first things first, right? We take off from where Wall Street left off yesterday night. So let's get that going. So decent rally in U.S. markets. NASDAQ is up 1% on your screen. U.S. Treasury Secretary Yellen, who caused all the damage the day before yesterday, spoke again, but with a slight modification, which helped sentiment. And she said, and I quote, "Certainly, we would be prepared to take additional actions if warranted." This is with regards to U.S. banking deposits. And, this was much more helpful. This was much more constructive. She said a few other things, but nothing which was construed to be negative. Now, markets kind of picked up. It was a late kind of pullback in the U.S. indices as well. The U.S. 2-year sank about 13 basis points. The 10-year saw a 1 basis point fall. But the 2-year, which is the most sensitive to any changes in Fed interest rates, etc., that sank 13 basis points. So the market, at least the rates market in the U.S. is telling you that it was indeed a dovish Fed. Yesterday, a lot of people were saying, well, if the Fed was dovish, even with a 25 basis point hike, why did the market sell off? The rates market 1 day later is telling you, well, it indeed was a dovish kind of Fed. Maybe we'll worry about why they were dovish a little later down the road, but for now, that's the interpretation. Thursday session, quickly coming to the market here. Thursday session was disappointing. We saw a late sell-off. The market actually, opened strong. We saw a sell-off for 3 or 4 hours. That was absolutely flat, and starting 2:30, we saw that big crack. Now, the immediate resistance for the Nifty is become 17,207, and the 20-day moving average comes in at 17,304. These are the very near-term immediate resistances. On the way down, 16,975 and 16,828 are important levels, which should be defended. So that's the near-term kind of trading setup. If you're trading, these are levels which become very important. Now, on the Bank Nifty, it was disappointing because we hit the 20-day moving average. The high point was almost not almost, we actually crossed it intraday and then sold off. So touched 20-day and then sold off and posted a sort of negative close. On the way up, the 20-day becomes important, which is now at about 40,154. That is the resistance. It's very near term, but we are in that kind of a market. And on the way down, the low of 38,941 will be important to hold. So these are interesting levels and important levels if you are trading very near term. The SGX is indicating a flat kind of a start, something what we were seeing yesterday as well at about 17,059. But let's from global get to the big story, which I think we'll discuss with experts, etc., in a bit from now. The amendments to the finance bill with regards to debt mutual funds. Surabhi.
Prashant, yes. So I thought I'll talk about Accenture's result and, so on and so forth. But let's forget that. Let's talk about the hot news at the moment. Yep. So first of all, this is still within the realm of course, conjuncture. It's a lot of conversation, chatter that's doing the round in tax circles and mutual fund circles. So that's the first caveat. You have to take that on board. Now, what the chatter is suggesting is that, we were going to talk about insurance. Insurance was supposed to be the big one, that will we get an amendment which gets a relief. The industry yesterday was talking about maybe that cap, the taxation cap being lifted from 5 to 7 lakhs. But move over insurance, the hot subject this morning is mutual funds. And why do we say that? You remember, go back to, the budget day, market-linked debentures were given a bit of a tax hit. Up till now, market-linked debentures were getting equity treatment because a lot of them were being redeemed just, after a year. And then you had that 10% capital gains tax with the benefit of indexation. So in the budget itself, the tax regime for MLDs was changed, which was a big hit. However, what is happening today, according to a lot of these sort of, circulars that are floating around, is that it seems that the tax regime will be changed not just for MLDs, but they have added specified mutual fund to the definition. So it's MLDs and specified mutual fund. So what is the specified mutual fund? Well, a lot of this right now seems to be pointing to any fund that has less than 35% equity. So as long as the fund has 35% equity or more, it gets equity taxation. If the fund has less than 35% equity, then it gets, clubbed in this new category, and it basically loses indexation. And that is why the industry seems to be up in arms. Everybody is up looking at their phones right in the morning. Because if this comes through, then we're talking about debt investments getting hit. Remember, debt funds right now get that benefit of indexation if you hold them for 3 years. If that's taken away, what is short-term capital gains tax? Essentially, it's taxing you at the slab rate minus the indexation benefit. And that was very, very important for big funds like the Bharat bond, etc. So debt as a category, we're also talking about gold funds. We're also talking about foreign equity funds, because the definition right now seems to be suggesting only domestic equity, 35%, but in domestic equity. So we have to watch out for how this plays out. We'll, of course, get a lot of experts, tax experts, industry representatives to talk about this. But yeah, the finance bill will keep things
just 2 points to this. So anything, the thing says that after anything invested after the 1st of April 2023 will be subject to this first, right? So there is no retrospective or anything, but 1st of April onwards. It says that if you invest in debt funds and when you sell, that income will be added to your income, right? The gains will be added to your income, and you'll be taxed at the marginal tax slab, which, as you said, whatever your slab is. That is the change which has happened. The question now is, does it kind of almost make this entire category completely unattractive? And if it does, right, when we talk about asset allocation, experts come on and say, well, have money in debt, have money in equity. Debt funds is a very important, large route through which it happens.
What my curious question was, I was just looking at some data, and you guys have been tracking this for a very long time. The average assets under management for the Indian industry right now is close to 40.7 lakh crores. How much of that is debt? How much of that is equity?
40,000?
40.69 lakh crore.
I think the debt number would be very large. I'll have to get
I think it'll be larger than equity.
I think so.
It will be large. Though debt funds have been seeing a lot of outflows off late, but that's more because of the nature of the market and the way interest rates are moving.
The question is where will this money go?
If it goes into equities, then...
So what? Two things. One, the tax, because people look at post-tax returns, right? It becomes at par. Post-tax returns become almost at par with FDs. So it could be very positive for banks, number one. And second, will we see some of this money coming into equities? It's entirely possible as well. Although, the basic tenets of asset allocation, etc., stay right there. It's just that the category, debt mutual funds as a category, becomes far more attractive starting this morning, starting the 1st of April as compared to before that.
All right, so we will monitor this, and we will obviously have a lot of conversation around this, but let's then stick to the basics right now for the market itself. The SGX Nifty, like Prashant said, is indicating a flattish start, a mild negative, but the good part is it suggests a start right in the support zone. The good part is that over the last few trading sessions, if you look at it, the Nifty support has moved higher from 16,850 to close to around 17,000 to 17,050. Why do I say that? The last 3 trading sessions, the Nifty has bounced right back from 17,016, 17,108, and yesterday's low was 17,045. And looking at this, the FIs were tremendously short on the index futures, has perhaps after a very long time made their first purchase in index futures, 1,000 crore worth purchase, and 60% of that was allocated towards the Nifty, only 40% that to the Nifty Bank. And the Nifty Bank has been an underperformer. We'll talk about that as well. The FI has added 8,500 long contracts, covered a few short contracts. So from tremendously short positions of almost 92.5%, from 7.5% long positions, the FI longs have inched higher to 11%. The Nifty Bank hit the 20-day moving average yesterday, like Prashant pointed out, but fell from there and fell below the 200-day moving average of 39,717 as well. So that is a weak index right now. What could support the Nifty, and what explains the higher allocation of FIIs towards the Nifty than the Nifty Bank is IT. Nasdaq did well yesterday. Fed rate hike cycle nearing its end. That's what people are assuming, and as a result of which, bidding all the tech stocks up, and then Accenture's numbers as well, which we will talk about. The only fly in the ointment on the way up, we have stiff resistance at 17,200 upwards, because twice in a row, on 2 consecutive days, the Nifty has faced resistance upwards of 17,200 in this month itself. One was on March 14th, one March 15th, and then March 22nd and 23rd, which is yesterday and day before yesterday, where levels upwards of 17,200 were strongly negated. So that's something we'll watch out for.
Absolutely. I take your point. I think IT could be a sector to watch out for, because before a lot of this hit us, Adani, global issues, IT was the one pocket of the market that was doing well in tandem with US IT, though of course companies are very, very different. And we've seen that buying return on Wall Street, at least with the big tech names.
The only counterbalancing to that would be the fact that, we have a larger exposure to BFSI, which is not doing too well.
Yeah.
And secondly, the fact that Nasdaq rallied because of Apple. Apple is looked at more as a consumer company than a tech company. So will that correlation work 1:1? We don't know yet.
Well, let's see. Stocks are beaten down. We'll find out. Let's straight away take it to the equity call of the morning then. Christopher Wood of Jefferies says the valuation differential between India and China has reverted to its traditional mean after the huge 65% outperformance of MSCI China over MSCI India since the end of October 2022 to late January following the China reopening. This sets up the potential for renewed outperformance by India in an Asian and emerging market context, most particularly as dedicated long-only foreign investors are underweight India.
Well, let's get you some money market views as well. Bhaskar Panda of HDFC Bank says that several central banks hiked interest rates as expected, but what has caught the eye and imagination of market participants is that the US Fed is around the end of the rate hike cycle. He says this is now reflected in US yields across tenors, and says dollar index remains soft, so as oil and all this is good for the dollar INR, which showed resilience as the pair traded near 82 to a dollar yesterday. He says demand should pick up when the dollar INR pair nears 82. Hence, he expects the pair to trade in a range of between 82.825 to 82.45 to a dollar.
On bonds, Bhaskar says in the Indian bond market, yields have been trading in narrow ranges, and this trend is expected to continue for now. Hence, he's expecting the 10-year benchmark yield to trade in a band of 7.3 to 7.35%.
All right, we will have a lot of stock-specific action to track today as well. So we'll get to that in just a bit in our special top 10 segments. But before we get to all of them in detail, let's talk about what we're talking about. One is Nifty IT. We'll also talk about Campus Activewear. Interglobe Aviation held an analyst meet. Bharat Electronics and Hindustan Aeronautics on order wins. Vedanta is the other stock on our radar on the back of positive news flow. On the way down, we'll be watching out for HDFC AMC, UTI AMC, all the asset management companies, Aditya Birla Sun Life AMC, as well as Nippon Life AMC on the back of the news that just flashed at the bottom of your screen.
All right, Mark Matthews is now joining us. He's with Bank Julius Baer. Mark, great to have you with us here on the program. Thank you very much. First time we're speaking with you